Hey everybody, it's Larry Berman here, late Friday afternoon, coming into the US market close, and I thought I would go live this week at the end of the day, just given some of the interesting chart patterns that are developing. In particular, a follow through on the reversal patterns we highlighted last week. So let's dive right into the chart room and see what we've learned this week. Actually want to focus a little bit more on Canada up front because what we're seeing here is pretty notable in terms of what's happening with Canadian bond market yields across the board. I look at the 5-year because for most Canadians that's in and around where the mortgage market lies, and so what we're starting to see now and have been for a little while here is this 5-year part of the curve come down considerably in terms of yield. So I want to focus in on that a little bit this week and see what we can see there. So if I were to bring up a yield chart of the current 5-year Canada bond and look at the behavior over the last couple of years, there's a clear pattern here. So this bond was listed in October 2023 and has been trading ever since. I could put a generic bond in there to give us a continuous 5-year, but we're now back to very close to levels of the bet where the best and lowest yields were last December. Remember, we had markets pricing in a massive amount of easing. It didn't come, but now we're starting to see it in Canada. So, we're getting to that point now where the generic, let me bring up the generic so we have a longer term price history here. Going back through COVID and where did the bond yield get to? As we started seeing the rising interest rates, it was tough for the 5-year to get back below 3%. Like it broke through, it flirted with it, it came up, never really got more than 4%. But it's going to be really tough for that 5-year in the next, for you mortgage people out there looking to lock in, it's going to be really tough to see that come down to, in my mind, and hold below 3%. Again, given the deficit issues, given what I'm expecting as leadership from the U.S. market and the Treasury curve here. And I know there's recessionary calls, and typically the 5-year is going to come down hard. And that might happen if we get a much harder economic landing. But right now, the Canadian economy needs the mortgage relief. So we're probably going to see it come a little bit lower, but not a whole lot lower in my view, where that 5-year comes lower. So we've got a little bit of time here. If you look at what's happened or what's happening in terms of where things are priced in terms of cuts to policy. So in Canada, the next meeting of the Bank of Canada, obviously they cut this week, 77% chance that they go again in September. And then by the time we get to the December meeting, we're basically fully pricing in 2 more rate cuts. So again, 3.25, 2.75, 3%. That's where the 5-year's probably coming down into. But again, don't expect it to go back to extraordinary low interest rates like we've been used to for the past decade. So that's kind of where my heads are. Now, the biggest risk factor here for most investors is, holding securities that are outside of Canada. And that's been great because the Canadian dollar's generally been either flat or weakening for a number of years now. And if we look at the charts here, we can see the Canadian dollar at 125, roughly 80 cents in the last 2 years, weaker and weaker. So it's been very difficult for the Canadian dollar, other than a couple of spikes in the last couple of years, to hold above where we are today, 138 handle. So if the Bank of Canada is going to be more accommodative than the Fed, then the Canadian dollar probably starts now pushing through that 140. So I see it getting a little bit weaker still, but bigger picture, I wouldn't expect it to hold up there for too long. And this ties in the next couple of months. So for you snowbirds out there, Florida is going to get a little bit more expensive, and Arizona this winter travel season likely from that perspective. But at that point, from an investment perspective, I would be looking to have more exposure to Canada, and or if you're in an ETF that has US exposure, into a hedged version of that, so that when things do recover and the Canadian dollar stabilizes and we go back to say 130 or 125 a couple years out, that will help you in terms of your total return. So biggest impact really in what's going on here in Canada with rates in the US and the significantly lower rates we have in Canada than the US. That's really where we're at now. The purple line here and the green line is the 2-year rate differential, and you could see the trend of the Canadian dollar tracks that really nicely over long periods of time. So as Canadian cost of money in Canada is weaker than the US, then that's weaker Canadian dollar, and that trend is still very much in place. The other, of course, is our commodity that we trade most with our southern neighbor, and that is the price of oil. And so that's been range bound. The combination of these two things has kept the Canadian dollar range bound. I would expect if we're going into a harder landing that oil prices come down, and that would be yet another catalyst to weaken the Canadian dollar. So that's kind of what I'm seeing here, but ultimately intermediate to longer term right now, more bullish on oil, and I want to buy dips, but the influence on the Canadian dollar probably plays out to the negative for Canadians here. Let's look at the leadership here in the States and where the correction has been coming, and that is large cap tech. So again, a follow through week here, but really in context of the move up that we saw after the correction in 2022, the move up has been pretty robust, and no trend lines are really breaking. This is a weekly chart, so when we look at a 50-week moving average ballpark, we're looking at a 1-year trend line, 50 weeks, 1 year, and so still in an uptrend. I expect that uptrend will be tested in context of the next few months. So more downside here before there's really strong support, and what we've seen so far is probably just the beginning of this unwind. If we are going into a harder economic landing, then we could look at that rising 200-week moving average as something that ultimately would get tested, which really only takes us back to where support was just a few months ago, a couple quarters ago, which was still would be below the highs that we saw in 2021. So large cap stocks still very, very overvalued, more correction risk to come. But if you're long-term minded and you love tech, which I do, this is the buying opportunity, as we commented down here when we were breaking the 200-day moving average or 200-week moving average, and there were a lot of nervous people where our models were starting to say, hey, there's a lot of value here. This is where you start to buy. So, that point will come again later this year, early next. Not sure on the exact timing. And one thing they teach us in technical school is never predict price or try to predict price and timing in the same forecast. So we are going lower. There's probably much more correction risk here to the broader markets. Initially more rotation, and then once that hard landing becomes evident in the economic data, US CPI report that came out today, first estimate here of Q2 was more favorable. Markets rallied on that towards the end of the day here, starting to give up some of that rally. So we are seeing the late selling come into markets That is a behavioral characteristic of a bear market, not a bull market. When we look at the levers and we look at the yen and the carry trades, that behavior is what we're starting to see. There's a lot more unwind of leverage to come in the next few months if that correction process is going to continue to play out. Anyways, that's all we have. Hopefully, you've learned a little bit from the charts this week, and that helps inform your investment decisions going forward. Have a great week, everyone.